Today, here come the property price falls. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. Well, my thesis and modelling shows that availability of credit, driven by interest rates and borrowing capacity, is by far the largest driver of home prices. Cut rates and flood the economy with cheap money, and property prices are pushed higher, as happened through the COVID period. Lift rates, tighten borrowing power, and remove stimulus, and prices fall. This thesis has been proved over the past 3 years, with Australia's housing market suffering its biggest annual decline since 2008 last year, as sharp interest rate hikes sapped buying power and put off investors. Corelogic released their latest National Home Value Index, which fell 5.3% in 2022. That's the first decline since 2018. Annual falls were the biggest in the bellwether market of Sydney, which slid 12.1%, followed by an 8.1% drop in Melbourne. And national values declined 1.1% in December, according to the report. Now, it's worth remembering that the Reserve Bank raised interest rates by 3 percentage points since May to 3.1%, and it's widely expected to hike 1 or perhaps 2 more times this year. RBA officials have generally and publicly expressed confidence in Australia's housing market, highlighting that prices are still higher than at the onset of the pandemic, although recent FOI data underscored their concerns that falling prices will sap confidence, and this despite unemployment rate at the lowest level in almost 50 years. So they argue most borrowers are well placed to meet their commitments, and so loan arrears are likely to be limited. Well, we'll see about that. But overall, Australia's $9.4 trillion housing market has declined 8% from the recent peak reached in April, after surging 28.6% from a pandemic-induced trough, Corelogic said. The re-acceleration in the downward trend was mostly driven by a worsening in the monthly rate of declines across Melbourne, which, by the way, lifted 40 basis points between November's down 0.8% and December's down 1.2% fall. But declines also accelerated across Sydney, Adelaide, Darwin and Canberra month on month. And on the flip side, the pace of falls did ease across Brisbane and Hobart, while value movements in Perth remained slightly positive for the second consecutive month. Now, as I've said many times, these aggregate average indices are really not very helpful because, of course, they mask significant differences. Annual value falls were the most significant in Sydney, down 12.1%, and Melbourne, down 8.1%, where conditions peaked early in the year. Hobart was down 6.9%, the ACT was down 3.3%, and Brisbane down 1.1%. And that means recording an annual drop in housing values. While 3 capitals saw values rise over the year: Adelaide up 10.1%, Darwin up 4.3%, and Perth up 3.6%. The upper quartile of the housing market led the downturn through 2022, with most capital city and broad rest of state regions recording weaker performance across the upper quartile relative to the lower quartile and broad middle of the market. The more expensive end of the market tend to lead the cycles, both through the upswing and the downturn. Importantly, recent months have seen some cities recording less of a performance gap between the broad value-based cohorts, they said. Sydney is a good example, where upper quartile house values actually fell at a slower pace than values across the lower quartile and broad middle of the market through the final quarter of the year. Although housing values across the combined regional areas of Australia were roughly unchanged over the year, up 0.1%, the results were more mixed across the states. Annual falls across regional New South Wales were down 2.7% and regional Victoria down 1.3%, and that offset annual gains across the remaining regional markets. Regional South Australia has been the standout for growth conditions over the past year, with values up 17.1% through 2022, Corelogic said. The well-known Barossa wine region led the capital gains with a 23% rise in values over the calendar year. Despite the downturn across many areas of the country, housing values generally remain well above pre-COVID levels. Across the combined capital cities, dwelling values remained 11.7% above where they were at the onset of COVID in March 2020, while values across the combined regional markets are still up 32.2%. Melbourne is the only capital city where the current downwards trends are getting close to wiping out the entirety of COVID gains, with dwelling values only 1.5% above the March 2020 levels, Corelogic said. The relatively small difference between March 2020 and December 2022 can be attributed to a number of factors, including a larger drop in values during the early phase of COVID, a milder upswing through the growth cycle, and an 8.3% drop since values peaked in February. At the other end of the scale, Adelaide, where housing values remained 42.8% above pre-COVID levels, meaning that Adelaide dwelling values recorded a 44.7% gain through the upswing and have held relatively firm since interest rates started to rise, only down 1.3% from the recent peak. Advertised supply levels ended 2022 substantially lower than last year and well below the previous 5-year average. Over the 4 weeks ending on Christmas Day, there were 7.8% fewer capital city homes advertised for sale than a year ago, and the total advertised supply was down 19%. That was below the previous 5-year average. The lower than normal flow of fresh listings added to the market over the past few months has been a key factor keeping overall inventory levels low. New capital city listings added to the market over the past 4 weeks were 30.6% lower relative to the same period in 2021, and almost down 10% below the previous 5-year average. While advertised supply is lower than usual, home sales have also declined. Through the December quarter, estimated capital city dwelling sales were down 30.1% compared with a year ago and 9.2% below the previous 5-year average. In annual terms, capital city sales were estimated to be down 16.5% relative to 2021, but 7.4% above the previous 5-year average. Despite the drop in sales activity relative to last year's record sales volumes, Sydney, down 7.4%, and Hobart, down 18.9%, are the only capitals where the estimate of annual sales dropped below the previous 5-year average. National dwelling rent values increased a further 0.6% in December to be 2% higher through the December quarter and up 10.2% over the calendar year. Rents rose across every broad region and housing type across the country over the past year, ranging from a 4% rise in house rents across the ACT to a 15.5% increase in Sydney unit rents. While housing values have been influenced by interest rates, rental market conditions have been more closely linked to demographic trends through COVID. Fewer people per household through the pandemic, and more recently the strong return in overseas migration has added substantially to rental demand, they said. Over the coming year, high rental demand is most likely to be concentrated in Sydney and Melbourne, which have historically accounted for around 2/3 of overseas migrant arrivals. Such strong rental appreciation has occurred alongside record low vacancy rates. The combined capital rental vacancy rates finished the year at 1.2%, ranging from 0.4% in Adelaide to 1.8% across Darwin. Although rents continued to rise across most regions in December, Corelogic noted the pace of rental growth has eased in some markets. The quarterly pace of rental growth has eased from 2.9% nationally over the June quarter to 2% in the December quarter. The slowdown is likely reflective of seasonal factors as well as rental affordability pressures, forcing an adjustment in rental household formation. As renters face worsening affordability pressures, it's logical to expect more rental demand to transition towards higher density options where rents are generally more affordable, or for rental households to maximise the number of tenants in a rental dwelling, they said. High density rental markets across most of the capitals have been recording a faster pace of rental growth relative to houses through the entirety of 2022, with annual growth in unit rental values reaching 14.1% this year, compared with a 9.5% rise in house rents. While rental yields are generally still below the decade average, the disparity between the recent strong rental growth and falling housing values has seen the gross yield profile recover back to pre-COVID levels, with the national gross rental yield rising to 3.78% in December. Gross rental yields moved through record lows at the beginning of the year due to housing values rising at a faster pace than rents. Since then, gross yields have been on a rapid recovery trajectory, Corelogic said. Importantly, though, when factoring in the higher costs of debt since May, it's likely net rental yields have worsened for most investors as mortgage repayments have increased more than rental income. I'm certainly seeing that in my surveys, with a greater proportion of investors absolutely underwater from a cash flow perspective. Home values could fall further in the early months of 2023 before stabilising after interest rates peak, according to Corelogic. Despite the downturn across many areas of the country, housing values generally remain well above pre-COVID levels, Corelogic said, suggesting the sector is weathering the sharpest monetary tightening cycle in a generation. And in fact, Corelogic highlighted that 2023 was likely to test the housing market as record low fixed rate mortgages start to expire and such borrowers are forced to shift to much higher variable rates. Of course, an RBA document last month showed that some 30% of Australian borrowers on fixed rate mortgages will see repayments climb by more than 40% when their loans roll over in 2023. At today's 3.1% cash rate, monthly repayments on a 25-year $500,000 mortgage have increased by $834 since last May, or $1,251 for a $750,000 mortgage and $1,668 a month for a $1 million loan, according to Rate City. And based on RBA modelling, mortgage payments relative to income will increase this year to equal their previous peak in 2008. As interest rates peak and inflation eases, housing values are likely to stabilise. However, a broad-based rise in housing values will be dependent on interest rates coming down or on other forms of stimulus, Corelogic said. And the AFR's consensus surveys suggest most economists are counting on the RBA to be patient and to wait at least another year before easing, keeping with the US Federal Reserve's policy path. We expect the Fed will lead the developed market easing cycle in December 2023, said Chris Reed at Morgan Stanley. Through 2024, we expect most central banks in developed markets to ease policy rates back to more neutral levels of 2% to 3% as unemployment rises and inflation falls. So that means that we're going to see higher interest rates for longer. That means that property prices are going to continue to fall. And I'll remind you once again, the reason prices went up so high was ultra-low interest rates and huge amounts of liquidity stimulus from both the RBA and from the government. We're in a whole new world now. And so the expectation that I have is that property prices at best will go sideways over the next 2 or 3 years, but more likely will continue to fall. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.